Hello, this is Jonathan Riley of Lawrence Graham welcoming you to our webinar today on the topic of the government's new patent box regime, Inside the Patent Box, how the UK Patent Box can benefit your business. I'm joined today by my co-presenters Rachel Hossack from Lawrence Graham, and I'm also delighted to welcome Trudy Alder and Mark Bevington from Ernst & Young. Ernst & Young have been right at the forefront of the development of the patent box regime from the outset, and so it will really enhance our webinar to have their thoughts and insights today. I will of course introduce our presenters to you individually at the start of their presentations. The format for today is that we will have presentations running for just under an hour, which will follow the outline on your screen at the moment. And then after the formal presentations we'll have a panel discussion and our Q&A session, and aim to close in around an hour and 10 minutes time. The PowerPoints that will be on your screen throughout the presentations will be emailed to all participants after we close. You'll see from the slide on your screen at the moment that there's a dialogue box for you to submit questions at any time during the presentations. We'll receive and collate those questions and then discuss the most popular questions and any issues raised in the Q&A session at the end of the presentations. I would add that we do have a lot of participants registered for this session, so I do apologise in advance if we haven't addressed all of the questions by the end of the Q&A session, but we'll do our best to cover as many as possible. So let's get underway. Our first presenter is Rachel Hossack of Lawrence Graham, who's going to begin at the logical starting point by giving us an overview of the patent box regime, including running through the basic principles. Rachel is a senior associate specialising in the corporate law aspects of complex multinational group reorganisations and tax-efficient solutions, which is why she has a particular interest in the patent box regime. Rachel.
Thank you, Jonathan. Well, before I do a quick overview of the principles and the patent box regime itself, I'm first going to look at the background to the regime and the government's rationale for introducing this regime into the UK tax system. As the next two slides, I've reproduced some slides from the government's open event on the patent box regime, which was held on the 10th of January earlier this year. I won't read through these slides in detail, but just pull out the general themes from them. So it's one of the government's stated aims to be seen to be implementing a wide-reaching programme of reforms which are aimed at building a stronger and more balanced economy for the future. This is seen as particularly important at the moment given the economic situation that we've been in for a while and are still in and bumbling along the bottom of the recession. Another key aim of the government is to establish the most competitive tax regime in the G20. It's thought that this will support current enterprises and also help to attract more business to the UK. The government is implementing these aims in a number of ways which is set out on the slide in front of you at the moment, including reductions to the main rate of corporation tax, significant changes to the CFC, the Controlled Foreign Company Tax regime, reforms to the R&D tax credit, and also, importantly, the patent box regime. It's thought that building a competitive tax regime, including in particular the patent box, will then encourage companies to develop and exploit innovative solutions and products in the UK. If companies are locating their R&D, innovation and potentially other parts of their business in the UK rather than overseas, the hope is that this investment will be encouraged in the UK and that this will kickstart the much needed growth in the UK economy. The revenue, we understand, have just realised how potentially generous this regime is, because it doesn't really matter where the R&D activity is located as long as UK tax is paid. I'll also point out right at the start that this isn't some racy tax scheme which is on the borders of what's seen as morally right at the moment, but it's a regime which the government have created and which they want business to be aware of, understand and most importantly to take advantage of where it's relevant. The government is also keen to point out that by introducing this regime they are not trying to position the UK as a tax haven or try to encourage any artificial revenue shifting. Instead, they are trying to encourage development, growth, business in the UK and reward those companies, particularly those in the private sector, who engage in this activity. There are, of course, some anti-avoidance rules, which I'll touch on in a moment. We couldn't really expect a piece of UK tax legislation to be implemented without anti-avoidance rules. However, the government has accepted and indeed expects that businesses may wish to restructure their models or their contractual arrangements so as to ensure that they can benefit from this regime. So, looking at the principles of how the regime works, and we'll look at each of these in more detail as we progress through the session. So first, what qualifies? Well, this is defined in the legislation as qualifying IP. It's basically patents rather than any other forms of IP such as copyright, trademarks, etc. And as we'll see when we look at the income calculation more closely later on, value attached to the brand of a product is actually specifically excluded from the calculations. The patents which qualify are those which are registered at the European Patent Office, certain other European local patent offices, including the UK Patent Office, but importantly not patents granted in the US, and this could have impacts for quite a number of clients. We'll go through the government's rationale for this distinction later on in the presentation. It's probably important to point out at this early stage that the basic principle is that you only have to have one patented item within a product in order for the worldwide sales of the whole of that product to potentially fall within the patent box regime. And we'll look at this basic principle again in more detail later on in the presentation. So the second point on the slide, what income is included within the patent box regime? And this is defined as qualifying income in the legislation. And Trudy will take us through this in more detail later. But as I mentioned a moment ago, it basically includes all the worldwide income from the sales of patented products or products which contain a patent or a patented item. From this, there are a number of expenses and other allowances which need to be deducted, for example, routine costs. And then we get to a number at the bottom of the calculation. And as I said, Trudy will run through the concepts and some example calculations later on in the presentation. The potential benefit that you can obtain from this regime, the government's been marketing it as a 10% corporation tax rate on profits deriving from products from patents, and this isn't quite 100% true. In fact, the patent box regime involves a very complicated formula and a step process which effectively takes the relevant income out of the usual corporation tax calculation and then applies a lower tax rate to that part. And it's done as part of the corporation tax return at the end of the company's year. Not clear yet what supporting evidence, if any, HMRC will require or expect to be provided when a company is submitting its returns, including a patent box deduction. When the R&D credit regime was introduced, some companies spent a significant amount of time preparing supporting information and submitting this with their claims. We understand that the same people at HMRC will be dealing with the R&D claims and the patent box claims, so it might be that the same procedure is adopted for both and that there will be a requirement for things to be submitted, but we'll basically have to wait and see. But certainly, irrespective of what you actually are required to submit, a company will probably want to have a certain amount of supporting information in the background. The next point on the slide, the fourth one, the elective regime, this basically means that a company wanting to take the benefit of the regime needs to specifically elect into it. And indeed, we understand that this election in is the reason behind the patent box name. Belgium was one of the first regimes that had a patent box, and to elect into the regime, the company had to tick a box and elect into the regime, and we understand that that sort of tick box became known as the patent box, which then led to European patent boxes getting their names. An election must be made within 2 years of the end of the tax year to which it applies. Once in the regime, the company is in until it elects out. If a company was in and elects out, it then can't elect back in for another 5 years. So a decision to elect out must be made with due consideration. Quickly looking at the history of the patent box, the UK government's been considering introducing a regime for the taxation of patents since 2009, when they first started discussing patent box regime with any serious intent. In 2010, the coalition government announced as part of its corporation tax reform that it was going to continue with those thoughts around the patent box and that the regime would be introduced from 2013. The legislation was enacted as part of the Finance Act 2012, which was enacted in July this year, and the rules come into effect on the 1st of April 2013. It's going to be phased in, so from the 1st of April 2013 to 2014 you get 60% of the benefits, 70% for 2014-2015, 80% for 2015-2016, 90% for 2016-17, and then from the 1st of April 2017 it's in full force, so 100% of the benefits. Now, quickly looking at the anti-avoidance procedures, as I said earlier, HMRC have made it clear that taking the benefit of this regime is not abuse, and they're actively encouraging people to make use of it where they can. They've also recognised that it would be naive of them to assume that people will not try to arrange their activities so that they fall within the regime. However, they do want to discourage abuse, and therefore the legislation includes 3 particular areas which they consider to be an abuse of the system. The first is the mismatch rule, And this is basically where the parties put an arrangement in place where one party gets a deduction at a higher rate of tax than the other party pays on the same thing. This could include a mismatch between expenses and income relating to the qualifying IP, increasing the patent profits artificially through an implementation of a scheme of some sort, or recognising non-IP income as something other than revenue, for example capital, which may then affect the patent box calculation. The second is known as patent insertion. This is where a patented product is inserted into a particular product with the sole purpose of bringing that within the patent box regime. As I mentioned earlier, the basic position is that as long as a product has one patented item within it, the worldwide sales of that product will then potentially fall within the regime. The anti-avoidance rule introduces a concept that if that item doesn't serve a particular purpose within the product into which it's placed, then it shouldn't be included within the regime. My example that I've sort of come up with is taking a designer shirt, for example, which is obviously going to be sold at quite a significant price. If the manufacturer adds a patented clasp to that, but the clasp is purely decorative, has no purpose at all, then the addition of that clasp, even though it's patented, shouldn't bring the sales of the whole shirt within the regime. The third anti-avoidance procedure is where there's an exclusive license which is granted purely for the purposes of falling within the regime, and there's no other commercial reason for the grant of that exclusive license, or indeed for the license being exclusive. HMRC have noted that you can have an exclusive territory license for a particular sector or business, and that this should be commercially acceptable and therefore will be fine. However, where that sector is drawn so narrowly as not to be considered to be reasonable, there's a risk that the license will be deemed not to be a proper exclusive license. The example that they give is where there's two licenses for the same product in the same territory, distinguished only by the fact that one's for blue products and one's for red products. And on the basis that there's no commercial difference between the red product and the blue product, the fact that you've got two exclusive licenses and you've separated them into those two markets will be deemed to fall within the anti-avoidance and therefore won't fall within the patent box regime. So turning to qualifying IP. The IP rights, as I said, that potentially qualify for the patent box fall within three categories. The first are patents granted by the UK Intellectual Property Office, the IPO, and the European Patent Office, the EPO. The second are patents issued by other approved EU national patent officers, and the government published a list of these patent officers which they consider to have comparable search and examination processes and patentability criteria. So they're similar to the things you'd have to do for the IPO and the EPO. And there's 13 of these countries. They are Germany, Austria, Hungary, Sweden and Denmark, Finland, Estonia, Poland, Bulgaria, the Czech Republic, Romania, Slovakia and Portugal. Now, it's notable here that it doesn't include France, and obviously it doesn't include the USA that I've also mentioned earlier. And the rationale for selecting those 13 countries isn't to do with their tax regimes, but it's because, as I said, that it's believed that the applications submitted to those patent officers are properly examined, and so they're more likely to include real inventions rather than granted by an IP office which has less rigorous examination procedures. The exclusion of the Japanese and the US patents is also believed to be because their inclusion would undermine the UK policy of not granting patents for certain inventions such as business methods, which you can get in the US. And indeed, I understand that in the US up until September 2007 you could patent a tax strategy. I think it's highly unlikely that the UK government would ever allow a patented tax strategy to fall within the patent box regime. The third category of qualifying IP is a supplementary protection certificate. This is basically an extension to a medicinal patent which is granted if it takes more than 5 years from filing the patent to obtaining an EU marketing authorisation. It's granted for a period equal to the time between the filing of the patent and the granting of the marketing authorisation, less 5 years but subject to a maximum of 5 years as well. And similarly, supplementary protection certificates for plant protection products also fall within the definition of qualifying IP. There's 4 other similar related forms of qualifying IP listed on the slide. First of these is the so-called secret patent. This is where a patent is not granted by the UK IPO on grounds of national security or public safety. For example, where the patent information, if it was made public, would then prejudice the national security of the UK. It's probably worth saying there that when you file a patent, obviously the information in that patent then falls into the public domain, it's made public. So if that included something that was seen to be going against national security or would prejudice public safety, then the IPO and the government can decide not to grant a patent for that. But it still falls within the patent box regime because it would have been patented if it weren't for the national security issues. Secondly is plant breeders' rights. Not a lot to say on those other than they're granted under the Plant Varieties Act 1977 and the European legislation that goes with that. The third is regulatory data exclusivity rights, which are granted in respect of medicinal, veterinary and plant protection products. And finally, marketing exclusivity, which is granted to orphan status medicines and also medicines for paediatric use. Qualifying IP can also be for a patented process as well as a product. However, sales of products relating from a patented process will not generate qualifying income unless that patent includes a relevant product by process claim. As you may know, the UK IPO and the EPO allow a process patent to include a product by process claim where the claim is to a novel and inventive product defined by its method of production, but not where the product is not novel even if the method of production is novel. As I mentioned earlier, qualifying IP does not include designs, trademarks or copyrights, nor does it include pending patents, although it is important to note that income which arises between the patent application and the date of grant for a period of up to 6 years will then be recoverable in the accounting period when the patent is granted. So you can't apply it and get the benefit of that while it's a pending patent, but as soon as it becomes a granted patent you can look back 6 years and bring the income in. It's also worth pointing out that it doesn't matter when the patent was granted. There was a bit of debate while the legislation was in consultation stage as to whether only patents granted after a certain date would be capable of being included, but this appears to have been put into the quotes too difficult box, and now all granted patents, irrespective of when they were granted, can be included. That raises an interesting question as to what happens if a granted patent is subsequently revoked. And the IPO classically say that revocation has effect ex tunc, or from the outset. However, although the revocation is both absolute and retrospective, the English courts have not, for example, viewed the revocation of a patent as a ground to overturn an earlier binding court decision based on the patent being valid. And that's been the case since around 1908, and it was recently affirmed in 2009 in the Virgin Atlantic case. Where the issues of infringement and validity have not been finally determined by the courts, matter is res judicata between the parties, and it's not yet clear whether this principle applied by the courts will be similarly applied by the revenue in relation to the patent box regime. We suspect that it will be a matter of public policy, that it wouldn't be, in order because basically that would effectively amount to retrospective taxation, but we don't know how they're going to treat that as yet. It's also worth mentioning that other European regimes do have wider IP boxes. Some of you may have come across the Luxembourg IP box, for example, which extends beyond patents to include copyright on software, trademarks, designs, and even domain names. But it doesn't apply to copyrights on literary or artistic works, secret formulas, processes, and know-how. And also, in the Netherlands, the Dutch Innovation Box applies to profits derived from non-patented IP, for which an R&D certificate is acquired. R&D certificates are given for activities conducted in the Netherlands that either can't receive a patent but are still recognised as innovative and socially useful, or which could receive a patent but haven't because the inventor is reluctant to make the details of those activities public. The UK patent box regime will potentially play a part in the commercial decision making by companies, firstly as to whether or not to patent something, and also, I guess, where to patent it. So do you go for the UK on a simplified patent, or do you go for a European patent, which may take longer to obtain and also cover more jurisdictions? But that's basically it on the quick overview and the qualifying IP. So I'll hand over to Jonathan now to take us through the qualifying company rules.
Thanks very much, Rachel. Yes, as Rachel said, we've looked at qualifying IP, and the second criteria that we want to take a look at is the qualifying company. To be eligible for the regime, a company must be the legal owner or an exclusive licensee of a qualifying IP right. Patent holders may, of course, want to license their inventions for others to develop. The patent box is designed to benefit both the licensor and any licensee which has been given exclusive rights under which it develops and exploits the invention. Whether the company is the legal owner or an exclusive licensee of the qualifying IP rights, it must meet, though, what's called the development condition in order to qualify for the patent box. To meet the development condition, the company needs to meet one of the following criteria. It must create or make a significant contribution to the creation of the patented invention, or it must perform a significant amount of activity for the purposes of developing the patented invention, and that can include developing ways in which the invention may be used or applied, or perform a significant amount of activity for the purpose of developing any product or any process which incorporates the patented invention. Determining whether a significant contribution has been made is a question of fact, to be determined in the light of all the relevant circumstances. There are a number of ways in which a contribution could be significant, and expenditure is certainly not the only factor. For example, if a contribution has been made that has a genuine impact on the creation or application of the patented invention, that should qualify. So a significant contribution could be coming up with a breakthrough idea, or it could be work to test or enhance the viability or usefulness of the idea. So a contribution, in short, can be significant by reason of the cost, time or effort incurred, or it could be significant due to the value of the impact of the contribution which has been made. On the other hand, simply applying for a patent in respect of rights which have been acquired, or acquiring marketing rights and then marketing and selling a fully developed invention or a product incorporating the invention, won't be sufficient. The aim of imposing the development condition is to encourage businesses to actively engage in developing patents and exploiting them, rather than giving a tax break to a company just for acquiring and passively holding a patent. That said, it is specifically stated in HMRC's Technical Note and Finance Act Guide that qualifying development activity can include the commissioning of external research to develop the patented invention, and HMRC gives the example of commissioning the conduct of clinical trials of a substance. So at the moment it's not clear to what extent a company can subcontract R&D and still meet the development condition. In certain circumstances, a company may acquire fully developed qualifying IP as part of a wider project. For example, a company carries out R&D in a field of use and then finds that it needs to acquire a third-party patent in order to apply the results of its own R&D. For that reason, HMRC accepts that the development condition can be met if the development activity took place before or after the acquisition or the licensing in of the qualifying IP. And HMRC provide two examples of this. So both of these examples are from HMRC's published Patent Box Technical Note. First, a company conducts a project to develop a more efficient light bulb and undertakes a significant amount of research and development. But then the company discovers that the design of the light source they intended to use is already the subject of a third-party patent, which the company then acquires. The development activity will satisfy the development condition even though it took place before acquiring the patent. By contrast, HMRC said that if the company's only activity in relation to the development of the patented invention is related to the commercialization of a product or process that is otherwise fully developed, then this won't satisfy the test of contributing to significant development of the patent. The same will apply where activities are limited to other commercial and legal matters, such as the negotiation of a license or the challenging or defending of a patent. Second HMRC example, therefore, a company specializes in finding customers for innovative technological products, researching the market and bringing together the inventor and potential customers. It's sometimes rewarded for this by way of a share of future royalties from the licensing of the patented technology. The commercial development activity that the company performs in return for an interest in the patent will not satisfy the development condition. I said that if the company is not the owner, it can still qualify for the patent box if it's an exclusive licensee. So, having looked at the development condition, which applies equally to both owner and exclusive licensee, let's look at the requirements which apply solely in respect of an exclusive licensee. I say an exclusive licensee rather than the exclusive licensee, because the licensee doesn't need to hold all rights on an exclusive basis. The key element is that the licensee must hold some exclusive rights under the license in relation to the development, exploitation and defending of rights in the invention. The exclusive rights must cover at least a whole national territory. So a license that gives sole rights to, say, manufacture and sell an item within part of a country only, as opposed to the whole country, won't be deemed to be exclusive. On the other hand, the exclusive rights can be limited to a particular field of use, provided that, first, the rights are granted to the exclusion of all other persons, including the proprietor, and second, the effect of the grant of the rights, as a matter of fact, is to commercially exclude competitors operating in the same market from using the invention. But it's quite possible for the proprietor to grant exclusive licenses to several persons for use in the same country or territory, provided that their use of the rights over the patented invention is in unrelated fields of activity. An HMRC example of this is that an inventor develops and patents a chemical compound to be used on its own in a product that the inventor manufactures and sells. Recognising that other companies may wish to develop other applications by mixing the compound with other chemical ingredients, it grants a license to another company to develop those mixtures, but not the right to sell the unmixed compound. The licensee will be treated as having an exclusive license, provided that it's clear from the license that only the licensee has the right to exploit the compound as mixtures. A license that retains rights for the owner to license others to sell the same mixture under a different brand name, or to do so itself, or with minor differences but to use it for essentially the same application, would not provide exclusive rights over the patented invention, because the rights in relation to the invention will be substantially the same, namely to use the compound in a mixture with substantially the same outcomes. In addition, in order to qualify for the patent box regime, the licensee must either be able to bring infringement proceedings in respect of the exclusive rights granted to it in the patented invention without the consent of the proprietor or any other person, or be entitled to most or all the damages awarded in respect of that infringement. Commercially, there are relatively few arm's-length licenses at the moment which allow a licensee to bring patent infringement proceedings without the consent of the proprietor, so this may be a high hurdle for a licensee to meet. Let's briefly consider the issue here. One important consideration in deciding whether to bring a patent infringement action is that the patent owner is bringing their own patent into play in a dispute forum. The consequences of losing the action may not just be that the claimant fails to recover damages and ends up with a hefty costs bill. The patent owner might actually lose its patent as well. This is because the defendant, as well as asserting that it's not infringed the patent, will also be putting considerable effort into turning up some obscure prior art or otherwise trying to get the patent invalidated. Indeed, when the defendant first receives a cease and desist letter alleging the patent infringement, its tactical response may well be to commence its own invalidity claim with the Patent Office, so that it has in effect preempted the legal action and the patent owner now has to defend the validity of its own patent. So you can see the reluctance of a patent owner to grant a licensee the right to drag it into that situation. And as a bit of inside track, we understand that this is something the government might be prepared to have another look at. Finally, there are some specific provisions for groups of companies. The exclusive licensee definition is relaxed for certain intergroup arrangements. The group company holding the rights, either as proprietor or exclusive licensee, can confer rights held by it in particular patents on another group company, and that second company will be treated as holding an exclusive license even if the first group company retains certain specified rights that it needs to manage its portfolio, which means the right to enforce, assign or grant a license of those rights. The second group company is allowed to elect into the patent box as if it held an exclusive license, if it either has all rights in the patented invention or it has all rights apart from those rights to enforce, assign or grant a license of those rights. This might be the case where, for example, the original license holder is a group company whose primary role is the management of the group's intellectual property portfolio, and the development or exploitation of the right is carried on elsewhere in the group. If a company is a member of the group, then it must meet the active ownership condition. This is a condition then which only applies to group companies. However, the definition of group for the purposes of the regime is widely drawn, so that joint venture entities and smaller groups that might not be required to be fully consolidated in group accounts for Companies Act purposes can fall within the definition. The group company needs to meet the active ownership condition, whether it's the owner or an exclusive licensee. The group company can meet the active ownership condition by itself meeting the development condition, but in this event it must have remained in the same group since it carried out that qualifying development, which is in order to prevent the sale of a company being used as a wrapper for the sale of patent box rights. However, a company that continues with development activity of the same description, although not necessarily on the same invention, for at least 12 months after it changes ownership, can still qualify. Alternatively, the development condition can be met by another member of the same group, but in that event, the group company holding the qualifying IP must actively manage its portfolio of qualifying IP rights. This means performing a significant amount of management activity in terms of those qualifying IP rights, but note that this is tested at a company level against the company's whole portfolio of qualifying IP rights and not on a patent by patent or right by right basis. In terms of legal formalities, note also that the development condition can only be met by another group company if there are specific licenses in place between the two companies. Active management by the group company means being involved in the planning and decision-making activities associated with developing and exploiting its qualifying IP portfolio, and having clear substantive responsibilities, although the company doesn't have to make all decisions about the portfolio, particularly if, for example, normal group governance requires reference to a parent company board. Activities such as deciding on whether to maintain protection in particular jurisdictions, grant licenses, research alternative applications for the invention, or license others to do so, all count as management activity. Similarly, where the right to being exploited by incorporating the item into products, activities such as deciding on which products to market, what features those products will have, and how and where they will be sold, also count as management activity. Whether what's done is a significant amount of management activity is then to be determined in the light of all the relevant circumstances. But relevant factors are the resources the company employs, the breadth of its responsibilities for the IP, and the significance and impact of the decisions and plans it makes in relation to that IP. And this is all judged also against the significance and impact of the decisions and plans made by any other group companies in this respect, which ensures that the management activity is assessed in its proper context. We'll now move on to our presenters from Ernst & Young, Trudy Alder and Mark Bevington. Trudy is a senior tax manager in Ernst & Young's International Tax Services Group, based in the London office, part of EY's Patent Box core team. Mark's a partner in Ernst & Young's International Tax Services practice and leads its Intangible Assets Group, and is also in EY's Patent Box core team. Trudy is going to take us on to the next key stage after qualifying IP and qualifying company, which is qualifying income. And we'll then get down to the nitty-gritty of the Patent Box benefits by showing us some basic modelling, which is essential to answering the most important question, I think: is it worth it? Mark's going to expand on some of the issues raised by Trudy as the presentation develops, in particular adding some of his insights from his own close involvement in the development of the detail around the operation of the Patent Box regime.
Thank you, Jonathan. So the first thing I will cover is qualifying income, and this slide sets out the categories of income which will qualify for the regime. The first of those is licensed patents, and where a company licenses those patents, any royalties or license fees will fall into qualifying income. Broadly, the license should give the licensee a right over the qualifying IP or a right in respect of a qualifying item or process. It is worth mentioning at this point that where a single license grants multiple rights and only some of those are over qualifying IP, it may be necessary to subdivide the income from the license, and we will come on to that on the next slide. The second category is sales income, and I think the rules here are generous. And one of the things I might ask Mark to comment on when I finish this section is Rachel mentioned earlier other regimes from European jurisdictions. And I think whilst they may cover wider categories of IP, I think certain aspects of our rules allow more income to fall within the box. So income from sales of patented items or items incorporating a patented component or substance will qualify. And this means that the product, as Rachel has said, needs only one patented component, and all of the income from the sale of that product would qualify. The example often quoted here is one of a car, and the car would only need one patented component for all income from the sale of that car to qualify. So at this point, I'll just ask Mark to make a comment on other regimes and a comparison to our own.
Thank you, and good afternoon, everyone. I think it's right to say that our patent box regime is more generous than others, and I don't think that's an accident. The government was extremely careful to study other regimes and work out what aspects worked, what was attractive and what wasn't. Perhaps the nearest competitor to the UK regime is that of the Netherlands, which has a lot of similarities in terms of how the regime is constructed. But that has some key differences which it's worth focusing on. First out, in the Netherlands, you have to develop the intellectual property that relates to the patent yourself, so you can't buy it in. Secondly, the entrepreneurial element of the profit associated with the product or suite of products is something that the UK regime brings in very naturally, because it says that all of the income from all of the products is in, unless it is specifically excluded in one of the exclusions. And that's the opposite from most other regimes, which seek to look at the income which is associated with the patented intellectual property. And finally, it's worth remembering that the UK regime allows you to deduct your interest expense at the full rate of corporation tax, even if all of your income qualifies under the UK Patent Box regime. So in other words, you can have a situation where all of your income, in theory, is taxed at 10%, and all of your expense relating to interest is deducted at 22%. And that combination is significantly more generous in my experience than other regimes, and is causing a lot of noise around the world among innovators, and most especially in the US Far East.
Thank you. And just to cover off that section, I will just mention packaging, which is an interesting area. There is a basic rule that packaging should be treated separately unless it performs a function essential for the item's use. All the income attributable to it is trivial. A good example of packaging being essential is a drug delivery system, for example, delivering a patented drug, such as an inhaler. So even though the inhaler may not be patented, the packaging would qualify because it is essential. Where packaging is patented but not essential for the use of the product it contains, it is necessary to consider what income can be reasonably attributed to the packaging. Moving on to processes and patents exploited in providing services, the legislation allows a notional royalty to fall within qualifying income. The notional royalty should equate to an amount that the company would be willing to pay a third party to use the patent in an arm's length situation. And the calculation of this royalty should be calculated in accordance with OECD transfer pricing principles. I might just get Mark to comment. I know that there has been some noise around the regime not being fair to those with patented processes as opposed to those who have products that they might sell with patented components.
Yeah, I think that's right, that there is one area of uncertainty which I think still remains unresolved as regards this. And that's where you have an element of an overall process which is subject to a patent. But that element really is only coherent in the context of a much broader process which isn't patented as a whole. If the company who was producing the product that was the product of that process, if they own all of the intellectual property in relation to the entire process, then when you look at the notional royalty, you might be tempted to look just at that element of the process which is patented. Whereas if another company in the same corporate family were to own the entire patented process and were to license that process to the manufacturer as one coherent sum, then there is a good argument in our view that that entire amount would be within the patent box regime as regards the owner and licensor of the patented process. And what that means is that there is potential for a difference in tax treatments between the same activity in the same corporate family, depending on whether the intellectual property associated with it is housed in the same place as the manufacturer or a different place to the manufacturer. That doesn't seem that consistent with HMRC's intention to encourage simplicity where possible. And the issues that throws up are currently under debate between the Big Four and the Revenue Treasury, and particularly that's focusing on all the transfer pricing issues that surround the patent box regime.
Thank you. And just to finish on this slide, any receipt of infringement damages will qualify, and this will be the case even if the patent has expired by the time the company receives the damages, provided the infringement took place when the patent was valid and the company had elected into the regime at the time. Income from sales of qualifying rights or exclusive licenses will also qualify. Again, though, it's worth noting that if sales proceeds received relate to non-qualifying and qualifying rights, then it will be necessary to consider an apportionment, and I will come on to this shortly. So just to move on to income that does not qualify. Firstly, any income arising from oil extraction activities or oil rights is specifically excluded, and I don't really think there's much more to say on that matter. What is of more wider application is income from rights held under a non-exclusive license. Where a license includes exclusive and non-exclusive rights, it's necessary to treat the license as two separate licenses. A good example of this might be where a license is granted to a company to manufacture and sell products using a patented process in 3 territories. If the license were exclusive in all of the 3 territories, all of the income could qualify. However, if it were only exclusive in 2 of those, it would be necessary to consider the license as 2 separate, one being the exclusive license covering 2 territories and the other the non-exclusive territory. And only income from the notional exclusive license can qualify. We touched on this briefly, and the legislation also covers situations where mixed income arises. And this is broadly intended to cover the following situations. So where items give rise to qualifying income are sold together with other items for a single price, and situations where a single agreement is made which covers the sale of items or the grant of rights, only some of which give rise to qualifying income. So it will be necessary to apportion the income in these situations on a just and reasonable basis. It's worth noting that if the non-qualifying element is trivial, then no apportionment is necessary, and trivial is not defined, but it has been indicated that anything below 5% of the total would be considered trivial. An interesting point that I think it's worth mentioning here is that licenses granted over a qualifying right and other rights granted for the same purpose under a single arrangement will not need to be split into two separate licenses. So, for example, if a company is granted a right to use both a patent and a trademark under a single agreement in order to manufacture and sell a product, if those are licensed for the same purpose, then it is not necessary to apply the mixed income rules, and I think that's a beneficial point to note. The next slide describes how we get from identifying our qualifying income and reaching the number that is the patent box profit. So we've now identified that we hold a qualifying patent, we've identified our qualifying income. So what's the next step? The next step is to consider the taxable profits of the trade and identify the proportion of these profits which can be attributed to qualifying income. In most cases, this is generally a simple pro rata calculation. For example, if 50% of turnover is qualifying, it should follow that 50% of taxable profits are attributable to IP. There is an option, and in some cases it is mandatory, to use streaming, but I won't cover this in detail in this presentation. Certain adjustments need to be made to the taxable profits for the purposes of the patent box calculation. Firstly, any enhanced deduction taken in respect of R&D credits should be added back, and this is so that full benefit can be taken for those R&D deductions. Secondly, any trading loan relationship debits should be added back and any credits should be deducted. As Mark said, financing is outside of the patent box regime. It's completely excluded from the calculation. So if you have a financing expense, then full benefit can be taken for that. There is also another adjustment to be considered at this point, and this is known as the R&D clawback mechanism. This is designed to take into account prior year R&D costs for companies who have newly elected into the regime and where R&D expenditure may have declined post the patent being granted because all of the research has been carried out and the invention commercialized. I do not propose to go into this in a great amount of detail as part of the webinar, but essentially the mechanism works by considering R&D expenditure in the 4 years prior to electing into the regime. If after electing into the regime there is a shortfall in R&D expenditure, an adjustment is made to the actual R&D expenditure in the current year, and this has the effect of ensuring that pre-commercialization R&D expenses are taken into consideration during the early years of the patent box regime. For companies that have a continuous investment in R&D and a continuous innovation cycle, this should not be an issue. The next stage of the calculation is to eliminate a 10% markup on routine expenses. This essentially reflects the profits the business would be expected to make if it didn't have access to IP, and its removal essentially brings us closer to the profits attributable to the qualifying IP. What constitutes a routine expense is defined within the legislation and includes capital allowances, premises costs, staff costs, plant and machinery costs, professional services, and other services such as telecommunications costs, and the list is quite broad. However, certain expenses are specifically excluded. Finance-related deductions, again, we have already touched on this, and a number of expenses relating to R&D activity are also excluded, such as qualifying expenditure for the purposes of R&D tax credits and R&D allowances or patent allowances. The impact the routine profit element will have on the patent box calculation is clearly dependent on the type of business and business model of the company. For example, a trade with a very large cost base, such as a retail business, may see a significant impact. However, a much leaner business-to-business model may not see as significant an impact. Mark?
It's worth just reflecting on that, because 10%, I think, to a lot of people seems very high. And in fact, it was 15% in the first round of consultation. And so a lot of groups might say, well, if I have a net profit margin of around that amount or less, then does that mean that the patent box is of no interest or use to me? And there I think it's worth reflecting on the fact that it is only certain costs which are marked up. So, for example, your cost of goods sold, which may be significant for a number of groups, and your raw materials, those costs are not included in the 10% routine markup. So very typically, if you look at groups' overall cost base and then you work out what the 10% markup on specific costs relates to in relation to a percentage of all the costs, it's very much lower, and often lower than 5%. So if you are an organisation or you advise an organisation who has a lower than 10% net profit margin, don't assume that the patent box is irrelevant.
Thank you. The next step after eliminating routine profit is to eliminate a brand profit or a marketing assets return. The aim is to exclude profits that arise from using well-established brands. A marketing asset is broadly defined as anything in respect of which a passing off action could be bought, for example, a trademark or design right. So how is the profit attributable to marketing assets calculated? Well, it is necessary to consider a notional marketing royalty, which is essentially what the company would be prepared to pay a third party for the exclusive right to exploit those marketing assets. And this should be calculated in accordance with OECD transfer pricing guidelines. It should be noted, though, that where an actual marketing royalty is paid, this can be deducted from the notional marketing royalty, and only the difference would need to be eliminated. It is also worth noting that if the difference between the notional marketing royalty and the actual marketing royalty is 10% or less of the patent box profit, then no adjustment is required. The actual marketing royalty doesn't have to be that payable to a third party either. If a group company is paid an actual marketing royalty, that is still valid. After taking all of these steps, we arrive at the patent box profit. I just would like to point out, though, as Rachel has said, that for newly granted patents, it's possible to add on pre-grant profits arising in the 6 years prior to grant. I would, as a practical point, like to point out that it's worth considering how you might track this profit and keep adequate records in order to calculate this at a later date.
Let me add just one thing on the brand profit, which I think is very important for us to be aware of. The brand profit is probably the most controversial aspect of the patent box regime in terms of how this is going to operate and how the calculations are going to work. And the reason for that is twofold. First of all, HMRC are tending towards the view that brand has a broader definition than we and others think that the legislation says. It actually relates to trademarks and customer lists. And transfer pricing economists will often refer to brand intangibles that are broader than that as being very different and distinct. And the second difficulty is that if you own that brand intellectual property yourself, then when considering what an arm's length price might be, you have to ask yourself the question, when was the deal struck? Was it struck at the beginning of the process where a brand might have been not very valuable because it is associated with the innovation concerned? Or is it from year to year? And all of those issues, I think, are yet to be fully grounded, and I would expect to see modification of the revenue's initial guidance on the point.
I'll move on to the next slide now, which shows a numerical example. And I do not propose to talk through this in great detail. Essentially, it attaches numbers to the steps we've described on the last slide. So the first step is identifying the qualifying profits, and it has been identified in this particular example that 70% of the company's income qualifies. So it follows that profits attributable are 70% of the taxable profits. But note that this is after the enhanced R&D deduction has been added back. Next, the 10% markup on routine expenses is eliminated. And again, the routine expenses are also apportioned in line with the percentage of qualifying income. And next, the marketing assets return is eliminated, leaving us with our patent box profit. The point I would like to draw out of this slide is the way the patent box benefit is given effect. The beneficial rate is achieved by using a formula which achieves a 10% effective rate by giving a deduction which is taken in the company's corporate tax computation. Any profits left after this deduction are taxed at the normal full rate of corporation tax. And I think at that point, I'll hand back to Jonathan.
Thank you very much, Trudy. To round off our review of the patent box regime, I thought it'd just be worth briefly considering how the patent box regime might affect a company's patenting strategy. And the first aspect I want to consider is what I call the cost-benefit analysis, because I have to say that personally, I doubt that in most cases the patent box is going to be a significant factor in terms of the cost-benefit analysis, in that you have to have qualifying income to benefit from the patent box. And if you're sufficiently confident that your invention will generate income, then 9 times out of 10 you're going to patent it anyway. So the patent box won't be a determining factor as to whether or not to patent. And if you expect to generate income which will be subject to UK tax, then again 9 times out of 10 you're going to patent in the UK anyway. So the patent box won't be a determining factor as to whether or not to patent in the UK. It might tip the balance in some cases, say on some of those process inventions where the black box approach might be a viable alternative, by which I mean where there's an innovative process to produce a product, but all that anyone sees in the public domain is the product which is produced by that process, and the process can't be worked out from inspecting the product. In that situation, the inventor might decide that rather than patent the process, which involves disclosing it, he's commercially better off just keeping it secret. So whilst it's perfectly sensible for patent attorneys to advise companies to ensure that wherever possible, new product developments are covered by a qualifying patent, if the cost-benefit analysis stacks up, then the company's probably doing that at the moment anyway. Where the patent box may be more relevant, of course, is as a driver to creating patentable inventions in the first place. That's obviously what the government wants, but it may not always work the way that they intended, and that companies may now seek patents on specific aspects of a product in order to treat all of the income from that product as qualifying income. Rachel's talked about anti-avoidance and the concept of patent insertion, but I think it's going to be a very difficult determination from HMRC to make in order to exclude a company from the patent box regime, except in blatant cases where it's obvious that the patent adds no commercial or technical value. Will the patent box lead to companies seeking to accelerate their patent applications on the basis that the sooner they have a granted patent, the sooner they can opt into the patent box and get the reduced tax rate? At the moment, there's actually quite a lot of tactical manoeuvring involved in the progressing of a patent application. For example, if a company is continuing to develop its invention, then it may actually wish to slow down its application with a view to amending its claims to include the results of its further work. Or it may wish to slow down an application in one country while it deals with an issue in another country that might have a knock-on effect. Or it may wish to extend the effective length of the commercial value of its invention by generating revenues during an extended application period, as well as the subsequent 20-year period from grant. The acceleration of patents is, I think, something that we might see, but it will be very much on a case-by-case basis. And it should also be borne in mind that relevant profits from 6 years before grant can be added to the relevant profits of the year in which the patent is granted when calculating the patent box deduction, which may be a mitigating factor in terms of needing to accelerate a patent application. And finally, will the patent box lead to a narrowing of patent claims? A patent application needs to properly describe the invention, but clearly the way in which 2 different inventors might choose to describe the same invention, including its applications, can vary considerably. One time-honoured approach is to adopt a pyramid-like claim structure, so that you start with a group of claims describing the core of the invention and the conditions and applications about which you're most certain, and then you introduce other groups of claims to see how far you can push the envelope before the Patent Office examiner objects. And then when you get the Patent Office response, you amend your application to either revise or drop those claims beyond the point at which the Patent Office objected. But that cat-and-mouse approach, as it were, is not a fast process. You're trading off the time to grant against what you hope with the scope of the grant. Where the aim, though, is just to get part of a product patented in order to bring all of the product revenues into the patent box, then the scope of the patent grant may well be a secondary consideration, in which case drafting the claims narrowly from the outset in order to reduce the risk of objections based on prior art, etc., may be the way to go. And that approach, of course, may also accelerate the time to grant. Well, those are just a few of my own thoughts in relation to the impact on a patenting strategy. We'd certainly be interested in hearing your own views, and we can pick up any other opinions during our Q&A session. Before then, I'd like to move on to our panel discussion and start that off by picking up again on the issue of cost. I talked a bit about the cost-benefit analysis in terms of a patenting strategy, and said I wasn't sure the patent box would be such a relevant factor in shifting that equation. So if that's the case, it must be important not only to say to the client that there's a new factor at play in the cost-benefit analysis of the commercial decision as to whether or not to seek a patent, but also to demonstrate to the client at an early stage and at a sensible cost to the client. With that in mind, can I table the costs issue to the panel and ask Mark and Trudy, what's the Ernst & Young approach in terms of getting clients to engage with the patent box process and working out whether or not it's a worthwhile option for them without spending a disproportionate amount of time and money getting to that answer?
Maybe I can give a little impact on that. Most of the people who we have spoken with who are interested in the patent box regime already have a significant number of patents registered, and those patents would include some or all of their products. So therefore, when you're thinking about a patent registration strategy in response to the patent box, you're really thinking about the extent to which it might change how much you could take advantage of the patent box regime, rather than thinking about whether it's going to throw you into the regime or not. And there it's worth remembering that because you only need one component in the product for the whole product to qualify, for many product-related businesses, there will be a few very prolific patents, which mean that a good proportion of the group's income that could potentially ever qualify can be identified and qualified just through seeking the patent on that component alone. And so for many groups, they need only focus on a few key patents in order to get much of their income in.
And what would the Ernst & Young approach be, as it were, if you had a client who simply said, I'd like you to talk to us about the patent box and see if we qualify, see if it's worthwhile for us?
Well, the first thing we would normally do is a very simple web search to see how many patents they had registered. And I think many on this webinar might know that it's a matter of minutes to get a very firm idea of what applications and grants there are out there. And so if there are patents that exist, then that is a very strong indicator that people can benefit from the regime. And interestingly, not everyone we have spoken to has realized that they have patents. So I've certainly sat in meetings where people have questioned the relevance of why I'm there because they have no patents, only for me to produce a list of those patents, to much surprise. So I think it is worth remembering that even if you're within an organisation and wondering how on earth you're going to find out what patents there are around, recourse to the web is a very good start.
Yeah, thanks. And Rachel, what's the Lawrence Graham angle on that? I mean, should the company be just working with the accountants, or is there a contribution that the lawyers can use to make at the planning and preparatory stage?
And I guess it would probably be a joint approach, but the things that we would be able to look at is sort of, as we've mentioned, it's not only people that own patents, but it's licenses. So we could look at licenses that are in existence, work out whether they are capable of falling within the regime, whether they're exclusive, whether they've got, as Jonathan mentioned, exclusive rights in there. If they haven't, we can help you renegotiate those, whether they're internal or third party, to make sure that they do have the right rights in, so you can fall within the regime. And I guess another thing that we could help, and again in conjunction with Ernst & Young, is restructuring groups. So if you've got patents and they're in the wrong companies, or the companies are in the wrong place, we can help move those around the group, get the patents into the right companies, look at intra-group licenses, that sort of thing. And we have a specialist team here at Lawrence Graham that sort of do that sort of structuring day in, day out, so they're completely familiar with moving companies, intra-group arrangements and licenses and IP and that sort of thing.
Yeah, it's interesting you took it onto the group companies, because that's the next topic that I wanted to come on to. Because certainly when we think about group companies and intra-group arrangements, the sort of questions which certainly come to my mind is, who in the group owns the qualifying IP, IP location, should IP be migrated into the UK or maybe out of the UK? Are there opportunities to bring formalising intra-group arrangements in a way which brings income into the regime? So Mark and Trudy, which of those would you like to start with, as it were, in terms of the questions, or maybe for group companies you'd like to start from a different point?
Well, let me reflect on one thing, and then Trudy, maybe we'll hear some of your reflections. What I think you allude to with regards to that broader response to the patent box regime is very real in my experience. So what has typically happened is that an early calculation has indicated that in a steady state there is a significant benefit to be gained from the patent box regime. And I think most people that I have dealt with have actually been quite surprised by how significant that benefit is. And I've advised many people who have ended up projecting an effective tax rate of less than 10%, which seems extraordinary when you first think about it, until you remember back to the point we covered a while ago, that interest costs are always deducted at the full rate of corporation tax. So once there has been a large benefit identified in the steady state, first of all, that is an encouragement to optimise what is already in the UK in the way you described, to make sure that ownership is in the right company to get maximum benefit. But a much wider trend, and one that I think the revenue is very encouraged to see, is that a lot of people are then looking to that which is housed overseas and thinking, why wouldn't I bring that onto the UK? Because the UK is a sensible, coherent jurisdiction for me. It has a good reputation. It's somewhere where I can naturally house activity and profit. And suddenly the tax associated with that profit is so much lower in the UK than any other sensible, credible alternative that makes for a very compelling business case to house, in some cases, all global IP centrally in the UK. And that, of course, was the purpose of the regime.
Yeah.
And I think the revenue are very pleased by the traction that is getting.
Yeah.
And I think just one point to bring out there is that certainly formalising arrangements and optimising arrangements, as Mark describes, it's been made very clear that that would not be caught by anti-avoidance arrangements. So definitely worth considering.
One insight which might be of interest is all of our respective organisations, I suspect, either explicitly or subliminally have a slightly different approach to new customers than they do existing customers. And HMRC is perhaps a little more explicit at the moment than certain other organisations. And if you are interested in bringing a significant amount of IP income into the UK, then you can expect a very proactive response from HMRC to support that. You can expect a very high level of service in terms of the help in any planning that is associated with that, the clearances, certainty around other tax issues. And that all underlines the focus that there is on promoting this regime and making it stick. Jonathan, earlier on in the presentation you mentioned David Gorkin, the quote that we saw in the slide. It's worth knowing he was in New York last week and he was specifically promoting the patent box regime and exploiting it to a number of multinationals. So we attended a meeting with him and 20 very significant US multinationals, and the engagement from that meeting was very high.
Thanks for that insight, Mark. For the last 5 minutes, I'll just move on to our Q&A session, just pick up on some of the specific questions that we've received during the course of the presentation. The first one, Rachel, is very specifically for you. Qualifying company, does that mean that's the only vehicle? What about sole traders and partnerships and other legal entities?
Well, in order to take advantage of the patent box regime, the business needs to pay corporation tax. So partnerships and limited liability partnerships, sole traders, that sort of thing, are tax transparent, so they don't pay corporation tax. It's the partners or the trader that pays income tax personally, which unfortunately means that if you stayed as you were, you would not be able to take advantage of the patent box regime. I guess if you are in that situation, so you trade as a sole trader or a partnership or an LLP, and you have significant patents and are making significant profits, then it may be time for you to consider possibly transferring your business into a limited liability company so that you could take advantage of the patent box regime. And we'd definitely be very happy to sort of model that in conjunction with EY and advise you on that transfer of the business.
Yes, I said that was a question specifically for you, but just in case Trudy or Mark, you have anything to add on that?
It's worth noting that if a partner in a partnership is actually a corporate partner, it can still elect into the regime on its share of the qualifying profit.
Yes.
Okay, and then our final question, I know it's only our second question, but it might be a fairly long one, and I'm also conscious that time is moving on, is in relation to transactions like M&A and even IPOs at the moment, what should companies be doing at the moment, Rachel, in terms of those transactions, both looking to the patent regime coming in the future and once it is in effect?
Well, and I guess the M&A transactions, the IPOs, we're thinking here that there's obviously going to be an IP due diligence report produced as part of both of those transactions. And as part of that production of the IP report, if not now, but definitely in the future, there'll probably be a requirement to consider the patent box regime, either if it's in place and the company's elected in, or if it hasn't elected in, how that would affect its profits going forward. So we think if and when companies are looking at either an M&A transaction, or either buyer or seller, or an IPO or a similar transaction, then it will be something that they would need to consider as part of that due diligence, and also, as I said, how it would affect them going forward. If you want to add anything to that, Jonathan.
I was going to say, I was just conscious of the comment Mark made earlier about a company being in a steady state, but the patent box regime still having a beneficial effect for it. But I wonder if either Mark or Trudy have anything to add in relation to how they might deal with an M&A transaction where a company is either in the patent box or in the future might be able to opt into it.
Well, I think the most important point to focus upon is, unless you understand what the likely impact of the patent box regime is going to be on that company, then it's likely that your cash flow projections, which are underpinning your valuation and bid, are going to be made on an incorrect premise. And so I think for that reason alone, getting a good understanding of what the patent box is likely to mean for a target is very important.
Yeah, great. Thank you very much. Well, we'll need to close our Q&A session at this point. As I said earlier, the PowerPoints that have been on your screens during the presentations will be emailed to all participants after we close. For those participants who are English qualified lawyers, I'm pleased to say that this webinar is accredited and qualifies for 1 hour CPD, and our SRA accreditation code is on your screens now and will be in the pack, which is emailed to you. So I'd like to thank you all for participating today, and we look forward to you joining us at one of our future Lawrence Graham events. And thank you in particular to Mark and Trudy from Ernst & Young for joining us today. Thank you.